In this short video, we will discuss basis risk. We will first define basis risk and then give specific examples that exist within the interest rate, commodity, and stock markets. We will continue the discussion by describing how hedging can create basis risk and ways investors can reduce or mitigate that risk. Basis risk is formed by numerous factors that can be part of normal operations for commercials and portfolio managers. Basis can take many forms. There is location basis, product basis, calendar basis, even currency basis. And handling that basis risk for corporate entities and portfolio managers is an important risk to understand. Location basis is risk generated when there's a spread of products that are similar taken in a pair format, meaning long one particular product and short the other particular product. Basis risk can be on products that are fungible. For example, West Texas Intermediate and Louisiana Intermediate oil are the same products. They are delivered in different locations and therefore have location basis risk. Fungible means they can be delivered at any particular point because they are the same product. Location basis is only one form of the risk with specific types of products. In the world of interest rates, basis formed by on-the-run as well as off-the-run bonds, which can be considered new bonds as well as bonds that are not so new, since they are now off-the-run or not first in all maturities. Long-term capital, as an example, wound up taking large positions in on-the-run and off-the-run bonds as a basis, believing that that spread would always converge. But as we saw in the liquidity crisis, it can stay wide for quite a while. Complex risks are sometimes described as consisting of similar, simpler risks, one or more of which are spread risks or basic risks. For example, the market risk of corporate bonds over treasury yields can be described as a basis to treasury yields. This concept is known as a basis. Product or quality basis is a risk that arises from hedging with an instrument that is not the same product or quality as the product and quality of the instrument that you are looking to hedge. For example, jet fuel is often hedged with heating oil, as the futures and OTC derivatives market for heating oil futures, swaps, and options is much more liquid than the derivatives for jet fuel. While jet fuel and heating oil are similar and highly correlated, they are not the same product, and therefore you have a jet fuel basis risk. These two movements are not always consistent. Basis risk can be created by futures contracts that are used to hedge underlying assets such as what is traded in a cash market. Futures cash basis can generate substantial risks to cash as investors are looking to hedge their exposure. An example is that an investor might own a specific stock portfolio or Apple stock and hedge that exposure with S&P futures contracts, which generate a future to cash basis. There is also calendar basis, which is calendar spread risk. In this risk, from a hedging standpoint, instruments that have different maturities are used to hedge exposure. In another example, using the oil market, a large producer might seek to hedge their exposure to crude oil using NYMEX crude futures. NYMEX crude futures expire in the middle of the month prior to the delivery month. On the surface, it appears that a consumer or producer is forced to accept the basis risk and decide between hedging with one futures contract or another, as they have exposure across the entire month. However, there are instruments that will allow them to mitigate their exposure to calendar risks using over-the-counter swaps or options, which use an average daily settlement to use as a fixed for floating swap against your actual crude oil exposure. There is also currency basis risk. Foreign exchange traders who hedge spot positions with forward contracts are taking that forward basis risk. That is considered a calendar risk, and it incurs an interest rate differential risk. Basis risks can be unwound by eliminating positions completely, but the risks associated with basis are sometimes very necessary to normal business operations.